Hello learners, welcome to this course. Today's topic is financial management and overview. After going through this lecture, we shall learn about meaning of financial management. As you know, financial management is also known as corporate finance. So, this lecture will be beneficial to learn about financial management as well as corporate finance. Then we will learn about how financial management is related to other disciplines like accounting, marketing and other discipline of the corporate. Then we will learn about scope of financial management, that is also known as finance function. That means what are the different finance functions a financial manager or a finance manager has to perform in an organization. And lastly, we will go about learning objectives of financial management. So, this is going to be our structure of the lecture for today. As you can see, financial management talks about financial management is all about planning, organizing and controlling the financial resources of an organization. Now, I will tell you one trick to define the financial management or any management like marketing management, production management or so on. Finance basically means monetary resources, and if you clip in the functional definition of the management, that is planning, organizing and all that, so it becomes the definition of that particular management area. So, financial management is all about planning, organizing and controlling the financial resources of an organization. When we say planning, planning means deciding the quantum of funds, that is monetary resources required for the organization, either for the whole organization or for a particular project. It means we are talking about asset side of the balance sheet. I hope all of you are aware about what a balance sheet is. A balance sheet gives a snapshot of assets and liability of an organization at a point of time. Then second activity under the financial management is organizing. Here by organizing means organizing or arranging the funds which we have already planned. Sources of finance it talks about, that means we are looking at or focusing at liability side of the balance sheets. Then once we have arranged the funds, we will be talking about controlling, that means how to ensure effective and efficient use of monetary resources of the organization, because monetary resources are critical. These are also called as lifeblood of an organization. So, that will be the basic definition of financial management. As you can see, how financial management is linked to accounting, because generally what happens, the learners get confused. Are both of these terms, accounting and finance, synonymous or contradictory or rival to each other or opposite to each other? But I will say, let us look at the things. Financial management starts much before the accounting starts, whether it is financial accounting or management accounting or cost accounting. As we can see, financial management starts from the point when we have made a plan. Okay, we will start a project, we will start a business venture and we estimate how much money we need for investment in different type of assets. Assets may be land, building, plant, machinery and something like that. So, from how much is the estimate, that is the number one, and who will be providing the funds, that means supply of funds has to be ensured. For that purpose, we have shareholders and money lenders. You can say money lenders or banks or financial institutions. It means either the owners are contributing the money or we are arranging a loan from a financial institutions or from the capital market by issuing the debentures. So, that ensures the supply side of the funds. Now, once supply is there, that means we have arranged the funds, then comes the demand for funds. Demand for funds means different projects of the organization need an investment. So, for that investment will be made by the organization. Thereafter, main task of the financial accounting starts. It means Financial accounting will start once we have arranged the funds, started investing and operating the business. So, in that way, first it is the financial management which is originated in the organization, then comes the role of financial accounting. In between we have management accounting, which helps the managers in making a balance between financial management and the financial accounting, because management accounting is not compulsory, but financial accounting is compulsory. It is well structured. Management accounting and financial management are tailor made. According to the needs of manager, it can be molded. So, that is the way one side, that is supply side, is linked to the investment side. Now, once investment has been done, project is successful, sales revenue is being generated, that means cash generation is there, then again the role of accounting comes. In accounting we will record that will be financial accounting. Then management accounting, that means management of the organization, managerial staff of the organization will decide what to do with the cash which has been generated from the operations. They might decide either to distribute it among the shareholders as dividend or go for the reinvestment. That is where we can see cash generated comes back to the supply side. That means either we are making a return of the investment, repaying that, or we are further going for the investment of the same funds for expansion, diversification of modernization. It means we can see it becomes a cyclical process, but in between there is a role of government and the society. Now, you might be surprised how government is concerned about this or society is concerned about this. But let me remind you, all the resources which an organization consumes, whether it is finance, HR or materialistic resources or physical resources, they are controlled by the society, they are for the society, therefore, these should be used judiciously for the society. Here comes the role of government. Government will ensure that whatever monetary resources we have generated, these are used in an apt manner, appropriate manner for the benefit of the shareholders, stakeholders and so on. So, in the subsequent part of the lecture, I will tell you the difference between shareholder and the stakeholder. Let us proceed further. Why we say finance for non-finance executives? Because generally when we talk about financial management, or if you go back to the ancient era when business was started after the barter system, people used to think financial management is external task. They used to call it as outsider looking in approach. Now, why they used to say that? Reason being, whenever they thought about the finance, they were simply saying financial management or role of finance manager is only at the time of arranging the funds, thereafter he has no role. But let me remind you, finance for non-finance executive is much more important. How it is important, I will let you know. Let us talk about a marketing manager. A marketing manager is there, he is selling the product. He is designing a strategy or policy for sales of the product. Now, he has to design how much discount to offer, whether we should give 1+1 offer. Nowadays you can see there are many offers. Sometimes we get it buy 3 get 1 free. Now, how this particular offer comes into the picture? Before coming out with that offer, the marketing manager must know financial implication of that particular offer. It means if we give 3+1 offer, that means to say one product is being given free of cost to the customer as soon as he buys 3 products. Now, definitely that product which is being given free of cost must have costed the organization. Now, he has to evaluate by giving this offer how much will be the gain in the sales revenue, gain in the profit, and how much will be the cost by giving that free product. That means he need to go for the cost benefit analysis. That is where the role of finance comes. It means marketing and finance are intertwined, interdependent. Similarly, human resource planning. Whenever a human resource manager has to plan how many people are to be recruited in an organization, how much pay has to be given, whether we should give bonus or not, he cannot decide without consulting the finance manager, because ultimately finance manager will let us know how much profit an organization has done, and even then accounting can let us know how much profit we have earned, but definitely how much is to be distributed and how much is to be reinvested. That means again, while human resource planning, designing the pay package or remuneration of the staff, finance comes into picture. Similarly is the operations. Under operations we have production, procurement and all that. So how much raw material has to be procured or semi-finished goods have to be procured, and even if it is a trading organization, how much we should procure. Sometimes our suppliers might give us discount offer. That means if we buy in bulk, they are ready to give us 2% or 5% or 7% discount. Or if we pay well in advance, they are ready to offer us some concession or rebate. Now whether that rebate is worthwhile or not, because when we buy in bulk, our huge resources are involved. More capital will be invested in the inventory, and that capital has cost to us. That means interest or loss of opportunity cost. So we have to make a check and balance that whatever discount we are getting, is it more than the cost of funds or less than the cost of funds. If discount is exceeding the cost of funds, then definitely accepting the discount offer is welcome, otherwise it is not welcome. That means it is not accepted. So that's where I have explained to you how different managerial aspects of the organization, how different operations of the organization like marketing, human resource planning, HR, MIS operations are intertwined and interlinked with the finance. That means we can say nothing can run in isolation in an organization. Finance and other departments go hand in hand. So that was the brief intro about or introduction about financial management and how financial management is linked with the other things. Now let us see what is the scope of financial management, because we have defined it. It includes planning, organizing and controlling of the monetary resources of the organization. But when it comes to talk about the scope of financial management, so financial management encompasses of following decision areas. Number 1, investment decision. Number 2, financing decision. Number 3, decision related to working capital management, and lastly dividend policy decision. Now we will see all these 4 aspects one by one, and one more interesting thing, let me tell you, that once we understand all these 4 aspects, financial management course curriculum gets completed. That is a vast area, each activity will take us more time. So let us go for the understanding what is investment decision. Investment decision. The investment decision relates to the selection of assets in which funds will be invested by an organization or by a firm. That means to say, if suppose an organization is there that is already running very well, they have multi type of products, they are catering to the whole of the nation, or even they are exporting the goods also. But if they decide to open a new branch, if they decide to expand their production capacity, or if the company decides to launch a new product, every new area will require the investment. So company has to estimate, or finance manager in consultation with the other staff of the organization, other executives of the organization, has to find out how much investment is needed. Now that investment may be required in 2 type of assets, that is long term assets, which is assessed with the help of capital budgeting techniques. Now when we say long term assets, these are also the permanent assets, fixed assets or non-current assets. So these are some of the synonyms of different assets which are of long term nature, like land, building, plant, machinery and all that. Then we have the short term assets or the current assets. So these are the popular names, few people call it as current assets or few people call it as working assets, but more apt name is current assets. Now there comes the role of working capital management. So we have to decide how much funds are required to be invested in fixed assets, how much funds are required to be invested in current assets. So that will talk about investment decision. It means if you see that there is something called as business plan. So that is the first step of a business plan, deciding about quantum of funds. That means we are planning how much funds are required for a particular project. So every investment activity can be evaluated separately as a project. for the purpose of cost benefit analysis or financial flexibility. So, investment decision is nothing but the first activity of financial management, that is planning for the monetary resources required to be invested in different assets, fixed assets and the current assets. Fixed assets I have already told you, land, building, plant, machinery and all that, whereas current assets are inventory, cash balance, receivables, prepaid expenses and short term investment. So, these are the different current assets. One more way to define the current assets is the assets which are either in the form of cash or likely to be converted into cash within 1 year or one operating cycle. So, in the subsequent part of the lecture, I will let you know what is operating cycle. So, that is simple first step in the financial management or first decision in the financial management, that is investment decision. Now, once we have decided how much funds are required, second concern comes or second decision will be there from where these funds will be there. That means ensuring the supply of the funds. So, the concern of the financing decision is with the financing mix or capital structure or leverage of the organization. When we talk about capital structure, we are talking about mix of different sources of finance employed by an organization to finance its different assets. There are two aspects of the financing decision, the capital structure theory and the capital structure decision. When we talk about capital structure theory, that means we are talking about whether we should have borrowed money, only owner's money or a mix of owner's money and the borrowed money. That means making a check and balance between owner's capital and the borrowed money. Whenever borrowed money is more, we say company is trading on equity. So, trading on equity basically means involving more and more amount of debt, but let me remind you, involving more and more amount of debt or borrowed capital definitely will have a risk. Risk means probability of a loss. Now, why I am saying risk? If you borrow the money from a bank, let us say an organization borrows from the bank at the rate of 14% per annum. That means company has to pay 14% interest on the borrowed capital. Now, whether company earns profit or not, interest payment is legal and contractual obligation. That means to say, if by the end of the year company fails to earn more than 14% on the invested capital, definitely company will be paying interest out of its pocket. That means company's bottom line will suffer, company's profits will suffer. So, that is where we have to make a check and balance between owner's capital and the borrowed capital. Then comes capital structure decision. When we say owner's capital, then again that there are many sources through which we can fund it, like equity shares, preference shares or retained earning. So, that will be basically capital structure decision. So, that is the second decision under the financial management. First was investment decision, second is financing decision, and now once we have arranged the funds, whether it may be owner's capital or borrowed capital, and there are many other theories of classifying the sources of funds like long term funds and short term funds, that depends upon the requirement. If we need the funds for a longer time period, say 5 years, 10 years or 15 years or for lifelong, then we go for the long term sources. And if we need for it only 1 year, 2 year or less than 5 years and generally less than 3 years, we call it as medium to short term sources. Now, once financing decision has been done, it means investment decision is done, that means where we have to invest, supply has been ensured, then comes the role of working capital management. Now, you might be surprised, what is working capital? Working capital means requirement of funds for day to day activities. If suppose we have established a plant, we have commissioned the plant and next month it has to be inaugurated. Now, in the commissioning of the plant, major capital, major funds, major monetary resources might have been invested. Now, there comes the role of working capital. In next month when plant is to be inaugurated, we need some money to buy the raw material. We need some money to pay for the daily utilities like electricity, water, raw material, labor payment and all that. The money required for all those activities is called as working capital. and management of that money, that means planning, organizing and controlling of working capital affairs is called as working capital management. So, working capital management is nothing but planning for working capital, arranging for working capital, and after arranging, controlling the working capital aspects. So, working capital management is all about planning for working capital, that means estimation of working capital required in an organization. Then from where that money will come, because working capital can be of two types, permanent working capital and temporary working capital. When we say permanent working capital means requirement of working capital for the long time and generally for the whole life of the organization. So, that quantum of money is called as working capital. Whereas, to meet the seasonal and cyclical changes in demand, an organization might need extra working capital. That means extra investment in inventory, extra investment in receivables and so on. So, that kind of working capital is called as temporary working capital or short term working capital. So, depending upon that requirement, company will go for the financing of the working capital requirement. That means it will decide about the sources of finance. General theory is that, which is maturity matching theory, that what we do, long term working capital requirement is financed through long term sources, and short term working capital or temporary working capital requirement is financed through short term sources. So, that is called as maturity matching theory of working capital. Now, once financing has been done for the working capital requirement, we need to ensure liquidity profitability trade off. That means working capital or money invested in working capital, say in inventory, receivables or cash in our bank balance, then definitely it has to be controlled judiciously, because control will ensure that we are maximizing the profitability, at the same time ensuring the liquidity. That means quantum of working capital is available whenever it is required. So, that is all about working capital management, planning for working capital, arranging for working capital and ensuring the control, that is liquidity and profitability. So, that is the third decision a finance manager has to decide. Now, at this point of time, a finance manager definitely will consult production manager or purchase manager or sales manager or marketing manager. That is where we say finance and other departments are interdependent on each other. Now, once working capital management has been done, company is selling the product, and luckily with the best decision of the company, profits are flowing in. That means company is earning the profit. And as you might be knowing, at the end of every financial year, company will declare its financial results. That means how much profit a company has earned. Now, if suppose initial investment was 100 crore and by the end of the year, company has earned a net profit of 30 crore rupees. So, we see that company has earned 30% net profit on its initial investment. Now, question comes, what to do with this 30 crore rupees profit? So, there comes the role of dividend policy decision. The dividend decision should be analyzed in relation to the financing decision of the firm. That means we are going back to the supply side. It is a circular process. Now, what a finance manager has to do? He has two alternatives available with him regarding the use of profits, that is 30 crore which I have talked about. They can be either distributed to shareholders in the form of dividend. So, let me let you know, dividend means that part of the profit which is distributed among shareholders as a reward to them. Definitely shareholders are the owner of the company, they have supplied their capital, they need to earn profit on that one. So, dividend is that part of profit which is distributed among shareholders. Or a finance manager can decide we will not distribute whole of the amount of 30 crore rupees profit, rather we will go for the reinvestment. So, quantum of profit which is not distributed among shareholders is called as retained earning. So, at this point of time, a finance manager in consultation with the top management of the organization and the other managerial areas has to decide how much amount of profit to be distributed as dividend and how much amount of profit has to be reinvested, that is called as retained earning to be invested or we can say plowing back of the profit. So, there is a one term in the financial management, plowing back of the profit. So, that is reinvesting the profits. So, that is where the dividend decision comes into place. Now, as soon as manager has decided or company has decided that we will go for the reinvestment of the profits, then again the question comes where to invest it. So, again the role of investment decision is there, then financing decision, working capital management, and lastly again it will be dividend policy decision. So, in this way financial management becomes a circular activity, starting from the investment decision, ending with the dividend policy decision, then again starting from the investment. So, it becomes a circular process. So, that was all about financial management scope, or these are the decisions which a finance manager has to take while discharging his duties. So, let us proceed further in the lecture. Key activities of a finance manager or financial manager in an organization. Now, role of financial manager is not only to ensure investment decision, financing decision, and whatever I have talked about working capital management and investment decision. His role is much more broader. Performing financial analysis and planning, that is the another task he has to do. It implies determining the additional or reduced financing required resulting from increased or reduced productive activity. It means to say, if an organization goes in for the expansion or reduction of the activities, that means curtailing the activities, finance manager has to decide how much additional funds will be required for the expansion of the activities, from where this money will come and all that. So, that is performing financial analysis and planning how much additional capital is required for the expansion. Sometimes you might see companies go for inorganic growth. When we say inorganic growth, it means company is going for the acquisition or merger. Now, how to analyze the merger, how much money will be needed in merger, and from where money will come, all that activity a finance manager has to do. So, that is the key role of finance manager in performing financial analysis and planning. Then second role or activity is making investment decision. Investment decisions determine both the mix and the type of assets held by a firm. Expansion or modernization or acquisition will be in what shape, what will be the strategy for that, what will be the strategic financial decision or implication a finance manager has to do. The mix refers to the amount of current assets and fixed assets. So, he has to decide how much investment should go for current assets and how much should go for the fixed assets. So, that is where the key activity is finance investing decision. Once that is there, making financing decision, that means whatever shortfall is there, from where that money will come, and he will decide about optimal capital structure to achieve objectives of financial management. So, that was basically role of financial manager. Then we come to the last part of the things, objectives of financial management. Now, when a finance manager is performing all these activities, his main focus is either profit maximization or wealth maximization. When we talk about profit maximization or wealth maximization, profit and wealth are different. When we say profit, we are talking about absolute amount of money, 100 crore, 20 crore, 50 crore and something like that. When we talk about wealth, we talk about creation of wealth for not only shareholders, but for the all type of stakeholders. So, profit maximization, gone are the days of profit maximization, because when in the initial stage, business was started after the barter system, people were only concerned about amount of profit. How much profit I earn, 100 crore, 2 crore, 10 crore, 50 crore and so on. They never talked about profitability. Profitability means how much percentage we are talking about. It is a comparative or relative term or evaluation term. So, profit maximization is not the focus nowadays, because profit maximization talks about the maximizing the profit only for the owners, only for the shareholders. Whereas wealth maximization talks about creating wealth for all the type of stakeholders, including the shareholders. So, the goal of financial management is to maximize the owners, that is shareholders' wealth, as reflected in the share prices. As you can see, share prices go up and down daily. So, he has to ensure that activities should be in such a way, financing should be in such a way, so that ultimately share prices of the company go up and shareholders get benefited. He is not there to ensure profit or EPS maximization. That was when he is ensuring profit or EPS maximization, he is focusing on profit maximization. Therefore, wealth maximization is a broader term. It is much more required nowadays, because when we say wealth maximization, we are not talking only about the shareholders, we are talking about different other stakeholders like employees, customers, suppliers, creditors, owners and society at large. So, this is the way wealth maximization is much more broader concept. It will talk about all kind of stakeholders. At this juncture, let me tell you what is the difference between a shareholder and a stakeholder. Shareholders are the owners of the company, those who have supplied the owner's capital, whereas stakeholder means anyone who is connected or concerned or affected by the activities of the company, by the operations of the company, that is employees, customers, suppliers, government, society, because we are consuming resources of the society. So, by ensuring optimum utilization of all kind of resources, we can go for the wealth maximization of a company, wealth maximization for the stakeholders. So, that is all about the introductory part of the financial management, where we have learned about meaning of the financial management. So, if you see the first slide, what we have covered so far. So, we have covered about meaning of the financial management, that is planning, organizing and controlling the monetary resources. We have talked about how financial management is related to other discipline like accounting, marketing, production and so on. We talked about scope of financial management, that is investment decision, financing decision, working capital management and dividend decision. And lastly, we talked about objectives of financial management, that is whether it is profit maximization or wealth maximization. It should be wealth maximization according to me. All the companies practice like that. So, that is all in the first lecture. Thank you.